This is Scott Becker with the Becker Private Equity and Business Podcast. Today's discussion is advice to younger investors, and this is probably good advice for older investors as well. I get a chance to talk regularly, very often, with younger investors trying to figure out their long-term thoughts on investing. And the one thing that I preach is that there's one thing that's more important than any other thing in terms of your investing. And that one thing is deciding what your allocation is going to be to equities, to bonds, to cash. The cash part's an emergency fund, and whatever amount you decide you need to have in an emergency fund. The equities to bonds part of this is really, really important. And every investor will have a different perspective on this depending on your temperament. Some portfolios in any given year, if they're heavily weighted towards equities, can go up or down a lot in any given year or 2 or 3 year period. But in the long run, if they're heavily weighted towards equities, are likely to do better than one heavily weighted towards bonds in the long run. The flip side is it's so important to understand your own temperament. For myself, even though I understand intellectually, the longer term holdings in more equities is going to be better economically than a portfolio that's more balanced to bonds and equities. I also know myself, as we've discussed in selling out of Bitcoin early, that if I panic, I will sell some of those equities. And the reality is my real returns won't be anything like those published returns they say where, the S&P has returned 8% a year for 100 years. No, it doesn't if you sell out of your S&P when it tanks because you're scared, which can happen to me. So the most important thing for young investors to understand what allocation they could live with between equity, bonds, and cash, and then be able to live with that allocation generally through a long period of time. So when the market tanks, your allocation is balanced enough that you don't get nervous and sell down. You keep your allocation as is. When the market goes great, you also can live with the amount of money you're making in equity increases and acceleration, but not feel like you've got so much FOMO that you should put everything into equities. So the most important advice we give is deciding what is your core investment allocation, and there are great tools online for this. The other thing that I would say is we talk about this concept of core and explore. So you've got a core investment allocation between your equities, your bonds, and your cash emergency fund. Then that's your core, and that's 80-90% of what you do. It's very similar to running a business, 80-90% in your core business. The other 10 to 20% might be in individual stocks. It might be in alternative assets, private equity, real estate, venture capital. It might be wherever you put that, but you understand that the core of your portfolio is that 80 to 90% that you've allocated between equities, bonds, and your cash reserve to know that you could sleep through good and bad times and not have so much FOMO when the market goes up. So this is the single most important lesson for investors, particularly investors that become serious investors, is understanding what allocation works for you and what the likely outcomes of that allocation are over the long run. Like many of us, early on in my investing career, I had a huge amount of technology stocks. Those technology stocks all crashed, and that led me to do a lot of studying of principles of allocation. And I think it's the single most important thing an investor can learn is how they want to allocate their assets. Thank you for listening to the Becker Private Equity and Business Podcast. Thank you.